Stop looking at the price. Right now, the euro is sitting on a trapdoor that nobody is talking about. 1.1671 is holding by a thread, but the real danger zone sits just 22 pips below at 1.1649. That is the liquidity pool. That is where the orders are resting. The market is pricing in a European central bank that is too slow to act, and the sellers are hunting those stops. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can use right now to navigate this move, including a sniper level that nobody is watching. The trap is set, and if you are long right now, you are the bait that we are in a trending session with a deepening bearish momentum. This is not a fading environment, and it is absolutely not a range-bound one. The intraday structure is a strong sell on the 4-hour and the daily chart is aligning perfectly to confirm it. The only logic here is to look for shorts on a retest of the broken structure or an acceleration through the floor. Write this number down right now. The invalidation level that proves my entire bearish thesis wrong is 1.1740. Put a circle around it on your chart. If buyers manage to absorb all the supply and push a 4-hour candle body close above 1.1740, the whole narrative shifts from a liquidity grab to a short squeeze. Until that happens, every single bounce is a fresh selling opportunity. The path of least resistance is violently lower, and the moving averages are confirming the gravitational pull is heavier than most retail traders realize. If we break 1.1649 today, the whole structure shifts, and we enter a volatility regime that will catch the late shorts and early longs off guard simultaneously. Let's step into the chart and walk through the anatomy of this bearish breakdown. I want you to visualize the weekly time frame first. We have a massive rejection candle from the 1.2000 psychological zone, and the 200-week moving average is rolling over like a slow glacier, but it is devastating for the bulls. That weekly structure is carving out lower highs and lower lows, and this week we have confirmed a rejection from the midpoint of that range. Now, step down to the daily chart. This is where the real gravity lives. The 200-day moving average is sitting right here, acting like a brick wall. For the past several sessions, the price has tried to poke its head above that dynamic resistance and failed miserably. We are now seeing the 20-day moving average accelerate below the 60-day moving average. That crossover, that dead cross, is a momentum signal that brings systematic trend followers into the market, adding selling pressure on every small pop. The MACD on the daily chart is not just bearish, it is accelerating. The signal line is firmly below zero, and the histogram bars are expanding to the downside. There is no hidden positive divergence here to save the bulls. Buyers are exhausted, come down with me. Into the 4-hour time frame where the battle is actively being waged. The 60-period moving average is our dynamic resistance. That average is guiding the price lower like a descending ceiling. Look at the MACD on the 4-hour. We had a brief rollover attempt, but it failed to cross above the zero line. That is a failed rally signal. It tries to re-energize, fails, and the histogram flips negative again. That is pure momentum decay. The 20-period average on the 4-hour is pressuring the price right at the 1.1690 zone, and we are currently trading below it at 1.1677. This is a classic bear flag breakdown in real time. Now, let's look at the 60-minute chart for that granular confirmation. The 200-period average on the hourly is above the 60, and the 60 is above the 20. This is a perfectly aligned bearish stack. Every time the price tries to pop back to the 20-hour moving average, sellers step in and smash it back down. I am watching the MACD on the 60-minute for a reset. If we get a brief, weak bounce on the MACD histogram but the price stays trapped below 1.1700, that is the hidden trap. That is where the aggressive sellers will load up. The daily support and resistance numbers are remarkably clear today, and that clarity provides a high probability framework. On the support side, we have 1.1671 as the immediate pivot low that is acting as a weak magnetic floor. Breaking below that opens the gateway to 1.1649. That 1.1649 level is the structural neckline of the recent consolidation. A weekly close below 1.1649 confirms a breakdown that targets the 1.1600 handle, which is the next liquidity cluster. On the resistance side, 1.1740 is the ceiling I mentioned earlier as our invalidation point. Minor resistance sits at 1.1765, but honestly, if the price gets there, the short-term bearish momentum is already compromised. The zone between 1.1705 and 1.1715 is the intraday liquidity gap where shorts might get trapped. That is where we want to look for entries, not exits. The architecture of the chart is bearish, and it aligns perfectly with what the US dollar index is doing. Here's what most traders miss when looking at this chart. They see the 1.1671 level and they want to buy it because it held before. But that is exactly why it will break. The market knows the stop losses are resting right below that obvious level. We are seeing the US dollar index squeeze higher, and euro to US dollar is the primary antagonist in that move. This is a cross-asset liquidation event disguised as a technical breakdown. Yesterday's ECB speaker changed everything because they confirmed the market's greatest fear. The European Central Bank is unlikely to rush with rate hikes. Let that sink in. While the Federal Reserve is holding the line on a tighter for longer stance, the ECB is blinking. This is a policy divergence play in its purest form. The yield differential between US Treasuries and German bonds is widening again, and that spread is a direct anchor dragging the euro lower. The Bank of England, as reported alongside the ECB, is also playing the caution card, but the vulnerability in the euro is amplified because the ECB lacks the unified fiscal backing that the US economy provides. We need to weave the cross-asset narrative here because it confirms the trade. Euro to US dollar and pound sterling to US dollar are the dollar killers, but right now, they are being killed by the dollar. Cable is trying to find a floor, but euro is the weakest link in the G10 complex. This fracture between the euro and the pound is critical. If you see pound sterling to US dollar relatively stable but euro to US dollar collapsing, that tells you the selling is not just a broad dollar bid, it is a specific euro crisis of confidence. The Bank of England might be cautious, but the ECB's language is outright dovish. That is why the euro to pound sterling cross is also plummeting. That cross-rate flow is adding additional sell pressure on the euro to US dollar pair. It is a compounding effect. Now, let's connect the gold and oil heartbeat to this euro move. Gold is having trouble rallying because the real yields are supportive of the dollar. But the inflation psychology is not translating into euro strength because the ECB's hands are tied by a slowing core economy. If oil spikes on geopolitical headlines, that acts as a tax on the European consumer, further weakening the growth outlook and punishing the euro. The euro is being crushed between an energy import bill and a central bank that refuses to protect the currency. That is the dollar killer. Being killed by its own policy inertia. My 1 to 2 week directional lean is extremely clear. We are going to press lower to test the 1.1600 psychological barrier, and if the retail sales data or the next round of PMI numbers comes in weak, we are heading to 1.1500. The exact event that would invalidate this thesis is a hard pivot in the ECB minutes, or a surprising drop in US durable goods that craters the dollar. But right now, the path is down. The smart money is shorting euro rallies, and the positioning data shows institutional investors are piling into dollar longs. The risk sentiment in the S&P 500 also matters. If the S&P starts to roll over and we get a risk-off shock, the dollar gets a safe haven bid, and the euro gets hammered even harder. The S&P 500 and Bitcoin correlation acts as a forward indicator for liquidity. If BTC dumps alongside the S&P, the dollar rips, and that is a catastrophe for euro to US dollar longs. Most people will skip this, but this is where money is made. Keep watching because I'm about to map out the exact price triggers that separate the profitable traders from the gamblers. I have 3 distinct strategies for you, tailored to your risk appetite, and every single one has a defined stop loss and target. No guessing. No hoping. Just the math. The next signal changes everything because we are approaching the liquidity zone. If you are not prepared, you will chase the move late. If you are prepared, you will be filled at the optimal price. Strategy 1. The sniper, conservative. This is the patient play. You are waiting for confirmation that the bears have taken control of the floor. Your exact trigger condition is a 4-hour candle close below the 1.1671 support level. You do not sell the touch, you sell the acceptance. Once that candle closes below 1.1671, you know the liquidity at 1.1649 is exposed. You enter on the retest of the broken 1.1671 level, now acting as new resistance. Your stop loss goes 1 pip above the prior 4-hour swing high, which places it exactly at 1.1732. The logic here is that if the price recovers above 1.1732, the breakdown was a false flag, and we are heading back to range highs. Your target one is 1.1649, which is the immediate liquidity pull. Take partial profit there. Your target 2 is 1.1605, the next psychological support. The risk-reward ratio on this sniper setup is approximately 1 to 1.3 to target 1, but scaled into target 2, you are looking at a 1 to 2.2 ratio. What voids this setup is a sharp reversal candle immediately after the break, known as a long-tailed hammer, or a sudden ECB verbal intervention that spikes the price back above 1.1740. Strategy 2, the active trader, standard. This is the pullback play for those who want to participate in the downtrend without chasing the breakdown. Your entry condition is a shallow mean reversion to the dynamic resistance zone between 1.1705 and 1.1715. This is where the 20-period moving average on the 60-minute chart aligns with the intraday volume-weighted average price. You wait for the price to struggle at that zone and show a 15-minute bearish engulfing candle. Your stop-loss placement reasoning is simple. Go above the congestion high. Place the stop at 1.1745. That gives you enough room to survive a noisy spike without getting caught in a stop hunt. Once target 1 is hit at 1.1675, move your stop to break even. That is the trailing stop rule that locks in a risk-free trade. Target 2 is the extension to 1.1650. The risk-reward on this structure is a clean 1 to 2. If you get filled and we grind sideways, you stay in until the momentum picks up or your break-even stop protects you. The active trader needs to be disciplined with the exit because the algorithm might tease a breakdown before the true dump. Let's see how aligned we are. Type your euro to US dollar range for tomorrow in the comments now. I want to see if you have 1.1700 as the ceiling. Drop your high and low prediction. I'm reading them, and I'll pin the most accurate one in the community tab. Strategy 3, the aggressor, high risk. This is the momentum chase entry on the smallest timeframe extremes. Only for those who know how to lose small and manage risk aggressively. If the price slices through 1.1671 with high velocity on the 5-minute chart without pausing, you sell the break of the low of that 5-minute candle. Your tight stop goes above the break candle's high, approximately 15 pips away. Invalidation is immediate. If the price reclaims 1.1688 within minutes, you are wrong, and you exit without hesitation. Your target 1 is a rapid scalp at 1.1650. Your target 2 is a runner to 1.1620 if the volume spike confirms a liquidation cascade. This is a high burn rate strategy. You might get stopped out twice before the big break catches. You must accept that. Position sizing here is critical. Never use full leverage. This is a scalpel, not a sledgehammer. The aggressor strategy works best when the economic calendar is silent and the algo-driven flows are uninterrupted. If news hits, you pull the plug instantly. Never risk more than 1 to 2% per trade. That is not a suggestion. It is the difference between survival and a blown account. No positions through high-impact news like Federal Reserve speeches or inflation releases. Stops are non-negotiable. If your stop gets hit, the market is telling you that your hypothesis was wrong. Live to trade another day. Capital preservation is the only edge that lasts a lifetime. The one critical level for the next session is 1.1649. That is the line in the sand. A daily close below it ignites the next leg down. A bounce from it triggers massive short covering. Either way, you now have a plan for both scenarios. Tomorrow's focus shifts to the US dollar index resistance test and whether the S&P 500 can hold its trend line. That correlation is going to dictate the euro's speed of descent. If the stock market breaks down, the euro suffers a double hit from risk-off. Flows and rate differentials. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now on the channel. Check the end screen. I cover the funding rate reset and the liquidity grab that the algos are hunting right now. Understanding that cross-linkage will make you a better Forex trader instantly. Smash like if this analysis gave you a clear plan for your trading day. Subscribe and hit the bell for daily coverage of these 8 key assets. My name is Alpha Market Meridian, and I will see you in the next one before the next explosive move takes off.